I am excited that you have chosen to join us today. In fact, we're honored that you chose to join us today. Things are busy out there, and it means a lot to us that you take the time to kind of pause and see what's happening in the marketplace so that you can bring all that intelligence and value and convey it to your clients. So here we are, you guys. We're drowning in information, and yet we are starving for wisdom. So I sort of thought that was an interesting way to ponder, all of the numbers, all the data, and how to translate some of that into real value, real intelligence, real wisdom that will help you guys, uh, be better agents, provide better customer service, be more prepared to answer questions, so on and so forth. Okay, so let's do a quick breakdown of how I would like the next hour or so to go. So we're going to start with just talking about the market, some short and long-term trends. Then we're going to dive into market segmentation, so different property types and square footages and so on and so forth. And then we'll talk about our market reports and hopefully squeeze in a little InfoSparks demo. And I want to wrap up with an economic update, and then we will open it up for questions. I've already done a good bit of yapping today, so I'm hoping my voice holds up, so just bear with me. All right, so let's start with the market short-term trends. Well, I suppose let's just said we're going to do short-term. Let's talk kind of some macro trends before we dive in, just to kind of get our thinking hats on. So 3 trends. Buyer activity is remarkably strong. 2020 was a record-breaking year for sales. Both pendings and closings both reached their highest levels since at least 2003, but likely earlier. 2003 is sort of when our data starts. Northstar had a conversion. They weren't able to archive some of that old data. So it's kind of an apples to oranges type of thing. So, 18-year high, likely a 20 or it could be a 25-year high. We can't say for certain. Combine that with weak seller activity, right? Sellers barely budged in 2020. New listings rose a barely noticeable 0.1% compared to 2019. That said, this is important. December saw a 23% spike in new listings, and that's metro-wide, not in Minneapolis or St. Paul or Richfield or Bloomington. That is metro-wide. So, I mentioned things could be changing, perhaps, maybe a little bit. Inventory remains by far the biggest factor holding back sales and thus frustrating buyers. So actives are down 75% over the last 10 years, while sales and population have only grown. This one has got to be one of my new favorites. It did such an excellent job of sort of foreshadowing what was going to happen after, kind of after the COVID stay-at-home orders and some of the shutdowns. So this is showing activity. We're using our rolling weekly average of daily counts. We've got 2019 showings in light gray, 2020 showings in this darker gray. And don't forget, it's a little hard to see. And you know what? I think I'll make that a little bit of a different color down the line. But 2021 so far in blue, you guys can kind of see how we've started off. So it is, it's pretty clear to see the COVID impact. I hope your eyes were drawn to that, and this is to be expected here. After that decline, after that pullback, notice how we got back to all-time high. Well, let's crawl before we walk, before we run. We got back to break-even levels, right, fairly quickly, and then we were able to surge ahead of 2019 levels, right? So look at this gap where 2020 was well ahead of 19. Same story here. Looks like we had a little bit of a convergence here, but then again, we saw showings hover well above year-ago levels in December as well. And then let's go back to this little blue figment, this little piece here in 2021. It's still early, but it's early, but we are able to see a little bit of a trend, and that trend is 2021 showings so far. And the year is young, but 2021 showings so far are at the highest level they've been in I guess, the last 2 years. So even 2019 and 2020, 2021 showings are already trending ahead of those prior 2 years. Alrighty, as we do, of course, it's important to break down market activity into price points. So this is, again, just showings, and this is the same, well, the most recent week this year compared to that same week last year. So week ending Jan 17th of this year versus that same week ending Jan 17th of last year. So blue is old, gray is new. You guys can see we obviously had more showings on our most affordable product out there, sub 200,000. So 4,800 down to about 4,000, notable decrease there. And so where did those go? Where did all those showings go? I can tell you. It kind of switched here, right? Notice how gray is, above blue, and here gray is below blue. So much of that activity is shifting up the price points, the price ladder, I should say. And don't forget, guys, homes that would have been 195 a year or two ago, right, are probably more like 210, 2.25 even today. So we see some of this activity sort of shifting up the price ladder, the price spectrum, if you will. And that's the case all the way up the line into the luxury segments. Luxury is relative historically, and I guess officially we call it million plus, but I have to tell you, $600,000, $700,000, $800,000 is getting into some pretty luxurious, products for a lot of people. So some folks say 750 plus, some even say 500 plus. I don't know that we go that far, but maybe 750 or 800, is a decent breaking point. So let's see, guys, 180 to 360 would be doubling. So we've really seen a lot of activity in million plus. I think I've got another chart or two about that later on. All right, let's get our little whipped cream Pac-Man on the screen here. Market share. This sort of plate color is the pie that I have eaten. This sort of pumpkin-y, maybe custardy color is the pie that I have not yet eaten. So, this 25% or 20% of the pie, it doesn't really matter how big the pie is, 5,000 closed sales or 50,000 closed sales, right? 20% is 20%. So this one, as promised, looks at the share of overall showing activity broken down into individual price ranges. Again, you guys can see in our most affordable price point, looks like about 29% of our showings last year were in this sub 200K range. This year, I should say for the most recent week this year, it's only about 21%. So that's a notable difference. Even 200K up to $250,000, we lost some showing activity. And here again, where did that go? Well, a lot of it went into 250 up to 300, but some was also distributed into these, some of the higher price points. So showings on properties priced between 300 and 400,000 went from 11.7 to 13.8% of showings, 8.6 up to 11% and 4 to 500,000. That's a pretty big jump too. And then, all the way up to million plus, from 1.1 to almost 2%. This one's interesting. So a little bit of a decrease. Nice, David, a decrease. A little bit of a decrease here from 600 to 800,000, which is interesting because that's been a segment that's been growing. So another way to think about this, I just showed you guys the change, the kind of the before and after, but let's look at the percent change. So unsurprisingly, our only segment to have lost, any kind of share of showings or any kind of showing activity is this under 200,000, compared to that same week last year. You guys can see our million plus, that was a 90% increase, definitely our biggest gainer up in that luxury, up in those luxury tiers. Don't discount this, 400 up to 500,000. We've seen nice growth there, even some nice growth in some of our more affordable segments, maybe not our most affordable segments. Alrighty, so this one, this is from our weekly blog. Hopefully you guys are able to check that out. That's in our weekly newsletter tray, Today's Real Estate. So do watch for that in your inbox. This one will show new listing activity, as we hint at up top. We've got 2018, 19, 20, and 21 in varying shades of, I don't know, blue or purple or something. So here is 2018. 2019, 2020, and then look at 2021, right, in black here. So far this year, I would say it's off to a pretty slow start in terms of new listings. It appears to me to be at the lowest of the previous 4 years so far this year. And I'll say it again, the year is young, folks. The year is young. So that's new listings. How about pending sales? Can we see anything different here? I'm definitely seeing something different. I hope you guys are too. So again, look at our 2021 trend line. We are already above 2020 levels, as well as 18 and 19 levels. So, if you look at 2020, right, guys, here's the COVID dip in 2020. We got all the way back. We hovered way above pending sales levels for the previous 3 years. And we remained there for really quite some time. So not only do we make back these losses, we made back all those losses, and then we added some on top of that. And so notice how 2020, in December was still pretty strong. This year, 2021, is still hovering above all 3 of those previous years. What does this tell us, guys? That's a lot of words. What does this tell us? Demand is already ahead of the previous 3 years. Supply is already behind the previous 3 years. Seller activity slow, buyer activity robust and strengthening. All right, let's talk more about the market. And you can see below, we're going to talk some long-term trends. Well, I suppose we've just got a couple more weekly things, but we're going to get into some longer-term things. So take a look at this. Change in new listings by price range. Most recent week this year compared to the same week, roughly the same week last year. Remember though, 7 days is 7 days. So does it really matter if it ends on a Tuesday or a Saturday, right? As long as you've got all 7 days in the week, it should be a fairly apples to apples process. What sticks out to me right away is this 500,000 up to 750,000 range, where we saw a 33% jump in new listings. Some of that's builders, some of that's maybe downsizing boomers, some of that is maybe upsizing third home buyers. We see decreases in listing activity in all price ranges under 250,000. So every price range under 250,000 showed fewer new listings the most recent week compared to the same week last year. Overall, it's down about 5%. How about on the buyer side, on the demand side? Wow, 70% increase in signed contracts over 1 million. Again, really a remarkable figure. I know some of you do swim in that pond, and I know others are hoping to swim in that pond one day. I'm sure you'll get there. So take a look at this. Big decline, 150 to about 200,000. Little bit of a bump, 120 to 150. So we saw a little bump in offers there. And then, of course, there's just so little product under 120,000 that you just wouldn't expect much change here. This one is a nice place to pause as well. 350 up to 500,000. Maybe folks don't always think of that as a first-time buyer range. It's surely a move-up buyer range. And I have colleagues, friends, family who are looking at 350, 375 as that first-time home, especially locking that in at 2.7%. Even if it's something you can grow into, people are finding that makes a lot of sense. All right, so now, forgive me guys, now we're getting into some of our longer term trends. So this is December 2020 compared to the year prior. We're looking at new listings. Don't even have to address it anymore. Of course, our most affordable range is well down, even 150 up to 200 down a hair. Here again, we see our 39% gain in seller activity in new listings in 250 to 350. This is a pretty encouraging sign, right? This is a relatively affordable price point. And over the last several months, we saw a lot of activity in sort of these luxury brackets. It's nice to see that, creeping down or trickling down into our maybe mid-market ranges or the higher end of the affordable ranges. It's always funny how we talk about these things. Let me do a quick check on chat. Oh, okay, we're good. Okay, so then new listings. Yeah, look at million plus. That was the winner, up almost 60%, 57%. Overall, just like we said at the beginning, December saw a 23% increase in new listings, even though the year as a whole was up 0.1%. So things might be changing a little bit. How about on the demand side, on the pending sales side? So we're looking at the number of accepted offers, signed contracts, December of 2020 versus December of 19. So overall, maybe let's just start big picture. Overall, December saw a 16% increase in pending sales. 16, it sounded like I said 60, 16% increase in signed offers. It was an almost 60% increase in million plus offers, and it was a nearly 20% decrease in accepted contracts between roughly 150 and 200K. Again, some of these mid-market ranges, it's nice to see these gains. I know this is where a lot of the demand is. Well, technically, this is where the demand grew the most, but it's not where it is the most, right? It is the most in these ranges, even though this one had the strongest growth or change. Okay, these are some of my favorites. We're getting into some of the truly long-term trends, not just year over year and not just the last 3 or 4 years like we saw in those rolling weekly charts. This one really goes back to 03. Now, why is that important? A couple reasons. First, we like to put things in context. So imagine if this, 3,100 figure was just sort of floating there. And let's say, my chart only went back to 2016, right? Well, wow, it looks like finally we're getting some sellers off the wall and onto the dance floor, off the bench and onto the field. Well, yes, that's true, but we're really only back to, 2012, 2011 levels, which is important because let me skip ahead to closed sales, 5,200. It is well ahead of any high, going back to 03 and about an 18-year history. So demand is as high as it's ever been. But look at new listings. Sure, it's nice to see these increases, but we're just not near where we were. Now, another important note to think about and consider is maybe we shouldn't have had all of these new listings, right? Maybe some of those were the result of our bubble. Maybe that was our overbuilt condo segment. We know condos, were a significant part of that bubble. So maybe we don't belong up there, but we're pretty comfortable saying we belong, let's say, at least near the 4,000 mark or so, maybe not 5,000 plus. So just a couple things to think about. Oh, also noteworthy, some people might look at this and say, finally, it fell from the sky. Well, actually, the last couple Decembers, we saw 4% and almost 5% increase, and now we saw 23%. Yet another factor to consider, oh gosh, I better move on. I'm spending too much time on this. Another factor to consider, guys, think about Minneapolis this summer and St. Paul, actually. As a result of some of the events that had transpired, we did see a pretty big increase in new listings, followed by an even stronger increase in pending sales. We've always said that things happen first, trends happen first in the condo market and in urban markets. Might that have happened anyway, maybe to a lesser extent? And now is that trickling out to the rest of the metro? Again, we notice changes first in urban markets and in the condo segment. So could that have been a harbinger? Now, don't get depressed about that. That's not a bad thing. We have so much buyer demand out there that it's nice to see sellers sort of refilling the proverbial bins. We need more inventory. This is a good sign. Depending on price point, it's not all over $1 million. So if we can get some product online between, 250 and 350 or 2 and 4, obviously people are going to be a lot happier. All right, got to move on. So pending sales for December, we did not quite hit an all-time record high. I guess it was the third strongest December since 03. So at 3720, a 16% gain in signed contracts compared to December of 19, quite a strong gain. Kind of similar to those gains we saw coming out of that Great Recession with 20%, 17%. So we haven't seen 16, 17 for quite some time, even though it didn't quite catapult us to these all-time highs for December. For the year as a whole, we easily were able to slingshot to new highs. So closings. So remember, guys, this is just signed contracts. Not all of these hit the closing table. The majority do, but not all. Obviously, more now than back then. But looking at actual closings, a nice round number here. I always like that, 5,200 even, up 21.5%, well above any December for any year going back to 2003, when we were able to first start capturing data. And you know what? Let me pause one more second here. Gosh, there's just so much to learn. Forgive me, guys. Notice how there were some signs that things could be slowing down, even on the demand side. So remember, interest rates got a little high in 2018, and we started to really run into the inventory wall. Now inventory is even tighter than it was, but rates are better, and there's a need for more space, and people are making changes, and so we can kind of see the impact of that. Why do I have two of the same thing? I can't answer that. Forgive me. December median days on market, cumulative days on market. How long do homes spend on the market before they accept offers? Well, 19 days, right? That was December 2020, 19 days as a median, meaning what? Half the homes took over 19 days to sell. The other 50% of homes had accepted offers in under 19 days. So that's a median, folks. Half above, half below. Median sales price of 305K, half the homes above, half the homes below. So 19 days on market is quite a ways away from almost 119 days on market. That's 100 days faster. So what is that? Almost 3.5 months, three and a quarter, 3 1/3 months. Again, really a remarkable change. Alrighty, December median sales price. So just for December, we were at 307, which was up 10%. For the year, though, I think we'll end up at 305, which was, if memory serves, more like an 8 or 9% gain. We're still doing some of that annual numbers before, some of that annual crunching before our upcoming press conference this Tuesday. So December price up 10% to 307,000. When's the last time we had a 10% gain? 9.7 was close, 9 was close, but technically you got to go back to 2013. So prices are rallying. They are, you could even say they're accelerating from 4 to 8 to 10. Safe to say this won't go on forever. And to be completely frank, maybe we want 4 to 6% year-over-year growth. Right? It would protect some of the affordability. It would preserve whatever affordability is out there. It would also be more in line with inflation, right? Just about double inflation of, call it 2%. So 4% would be double inflation. And don't forget incomes, right, guys? People's incomes don't rise at 10% every year. It just doesn't happen. I hope that's the case for some of you. I'm sure it is. But your typical business professional or blue collar, white collar worker, it doesn't matter. 2-3% is pretty common. So when homes get 10% more expensive year in and year out, it puts some of that product out of reach from too many people. So let's just keep that in mind. How about this one? Year-over-year change in median sales price with a mighty good-looking Loring Park right in the background there. Gosh, I do remember places. I remember places when we used to go to places that weren't our bedrooms or living rooms or kitchens or home offices. I remember places. Anyway, so take a look at this. The reason I love this is because it doesn't just show price, but we're actually plotting that year-over-year change in price. So here was the Great Recession. Yes, believe it or not, we lost 25% of our pricing. We went from about 200,000 down to 150,000. That's a quarter, right? That's a quarter less in prices. That's a 25% decrease in prices. Look at what our tax credit little mini stabilization period did, right? Looks like it got us positive for a bit, and then we had to kind of, find our natural footing. So overall, maybe it would have looked something like this. Take a peek at this now. Coming out of that Great Recession, we actually saw 18% year-over-year price growth. 18%. We sort of started to settle into this, 3 to 5, 4 to 6, maybe 4 to 7 range. For some time with some spikes and some valleys, obviously some peaks and some valleys. What do you guys see here? I definitely see some above average price growth. I think that's clear. Some of that is COVID related, some of that is interest rate related, lots of different factors there. But definitely you can see, heightened price growth like we saw here, and again, a variety of factors, but just it's nice to see that looking through this different lens, we can see different things happening. We can see things here that we weren't able to see by just looking at median sales price. Speaking of median sales price, let's take a quick stroll with our friend Jeff Bezos. So there's a joke, you guys, right? Jeff Bezos walks into a bar, or Bill Gates walks into a bar. On average, everybody just became a billionaire, right? Jeff Bezos walks into a bar, everybody on average just became a billionaire. Let's take a look. Six patrons at the watering hole, right? 40, this is the annual incomes, 40, 50, 55, 65, 90, 1.25, and there is $200 million. And I think that's on the low side. That's a bad year for Bezos, right? So there's $200 million. That puts the average income for this group at about $28.5 million, right? But what's the median doing? The median sales price, guys, is right here, $65,000. Why? 3 incomes were higher than 65, and the other 3 incomes were lower than 65,000. That's the beauty of a median. It's just the midpoint, right? Half above, half below. Look at how much more insulated, I like to say, the median is so much more insulated from outliers. Look at this outlier. It's an anomaly. Well, that anomaly really skewed our average, but our median resists that. That's why median is such a beautiful thing. That's why we like the median. So, if you think this is just an intellectual exercise, wait a second. Oops, I think I doubled up again, guys. Apologies. So let's now think about 5 houses, right? Here's your sales prices: 150, 2.25, 275, 3.5, $500,000, and then 3.5 million. What's our average sales price for this group? It's 830 grand, right? It's right here. What's our median sales price for the group? 312.5. Why? Because we have an even number here, right? We have to split the difference between 3 and 4. So halfway between the midpoint between 275 and 350 is, you guessed it, 312.5. So is that really fair that only 1 of 5 units is above the average? We had 1 unit that was above our average versus 50% above and 50% below our median. That, my friends, is why we like the median. Yeah, price per square foot. I won't spend too much time on this. Just know that, buyers are offering and sellers are accepting about $160 per square foot. So you guys can kind of multiply that through. I would encourage you not to just use that number. I would encourage you to go into InfoSparks and filter down to St. Louis Park or Richfield or Wayzata, and filter down to previously owned or new construction if you're in that segment. Just look at single family or condo or townhome, whatever you're doing. We encourage you guys to kind of get a little bit more granular. For the purposes of this webinar, I kind of have to paint with a broad brush just to kind of show us, the high level trends and the metrics and how to think through them. But then it's kind of on you guys to go and mine out that data, and then kind of treat it the same as we're treating it here. So 162 per foot, obviously ahead of the 140 per foot that we saw at the peak of the last cycle. We headed all the way down to about $80 a square foot, and you guys can see we're roughly double that. So 160 per foot. Let me just kind of geek out on this for 20 more seconds with you guys. So look at this. You got home A and home B, $200,000 home and a $400,000 home. Well, the prices are, you guessed it, folks, they're not equal. I know that was a brain buster. Prices are not equal. However, if we consider the fact that you get twice as many square feet and you pay twice as much money, on a price per square foot basis, they're both $100 per foot, right? So these 2 homes can look really different. And I guarantee you, $400,000 homes are going to look quite different than $200,000 homes. No matter the city, the property type, just doesn't matter. So what PPSF allows us to do is it enables us, it empowers us, I'd even say, to kind of really compare apples to apples, right? So yes, the price is double, but you get twice the space. So you're actually paying about the same per foot. Now, this is not a silver bullet. This is not an end all be all. There are obviously other factors. You're not just paying for square feet. You're paying for schools. You're paying for, well, we used to spend more considering location. I think location matters a little bit less now with remote work and remote classrooms. So there's other factors. How about the finish? How about the remodel? How about how many master suite, all these different factors, whether it's a walkout, whether it's a rambler, whether it's a split, whatever it is, there's so many other factors. This is just one way to look at this and to understand, might PPSF be telling us things that we can't understand from median sales price? And the answer is sometimes yes. So another way, what if price per square foot only rose 5%? But if we sold more homes and more larger homes, right, that means maybe sales price increased 10% while PPSF only increased 5%. So again, just a different lens. Percentage of original list price received at sale. This is one of my favorites just because it does such a good job at sort of showing us this balance between buyers and sellers. What was happening down here? The balance was out of whack, right? Buyers were in control. There's a lot of inventory on the market. The market was sort of in turmoil, lots of foreclosures, lots of worry and concern out there. And sellers who were motivated to sell, were forced to take 89% of their list price or 11% less than their original list price. What was going on here? We already kind of talked about this, guys. Remember that tax credit in 2009? That's why this looks like that. Otherwise, it would have looked like this. So I know we've had a political last few weeks. So some of our politics, well, maybe not our politics, some of our political decision making, obviously plays in, and that federal first-time homebuyer tax credit, you guys can see how much it moved the needle. And then last couple years, we started to maybe level off a bit, right? As we recovered from the Great Recession, we were 97, and then 97.1, and then 96.9, and then back to 97.3, and then right, COVID hit, and seller inventory plummeted, buyer activity surged, and of course that meant that sellers were getting darn close to full price offers. By the way, just spoke with someone who said a week or two ago they had their buyer wrote a $330,000 offer on a $300,000 house, and they did not get the keys to the home. So that would be that would be 110% of list price, and you're still not winning out. So pretty remarkable. 2.5% gain is really significant, and 99.7% is also a significant level, an extraordinarily high level. Yay, inventory. We definitely have plenty of it, so there's nothing to discuss here. False. That would be false. So let's just take a look at the count of the properties that are listed under active status in Matrix. We can see at one point we had, well, keep in mind, this is just for December. At one point we had 28,500 homes for sale. Some of you, I can just sense that your eyes started popping out of your heads. So this is just December. If you actually look at May or June or July of 2007, I think we actually reached 33 or 34,000 actively marketed properties. Folks, we've got 5,200. It looked like we could have been starting to turn a corner. Maybe we were going to kind of bumble around on the ground before starting to change. But we didn't. We saw buyers absolutely overwhelm sellers. We saw demand absolutely overwhelm supply. And this is the result. We shed 37% of our active listings. This was low. Heck, this was low. And look at where we are now. It seems like a game of limbo. MSI, month supply of inventory, also known as an absorption rate. So I actually updated this figure even more recently than what you'll see in some of our market reports. So InfoSparks is even more up to date. So this shows 1 month of supply. When I ran it a week or two ago, it was actually showing 0.9 months of supply. But we had some late status changes that kind of trickled in, and that moved the needle a little bit. You guys, 1 month of supply, it's completely unacceptable. It's just, it's so undersupplied and such a, I'll even say a ridiculous seller's market. And by the way, it has been since about 2012, right? When we had less than 5 months of supply. But it is just getting to a point where, well, It's getting to a point where even 30,000 over on a on a $300,000 home, right, isn't getting you the deal. So we're looking for 5 to 6. We would happily take 3 or 4, but 1 month is just woefully inadequate. Let's think through some of this. So understanding these supply and demand effects. Seller's market, like the one we're in now, less than 5 months of supply. You guys can read these. I won't go through all of these, but just know there's only 1 unit of supply. There's only 1 house on the market, but you've got 5 buyers that are really excited, all amped up, ready to go, ready to write offers, ready to outbid one another. They're all pre-approved. Their hands are up in the air. They're shouting, "Hooray, I am ready to be a homeowner." But they're finding that it's hard to get it, right? These things stay on the market for sometimes 2, 3, 4 days, some 18 or 20 or 30 million plus can be 200 or 300. But, and they're finding they have to go into multiples. They're finding that it goes remarkably fast. They're finding that they're having to, again, write offers sometimes at or above list price. So sellers markets are pretty tight markets, and the seller is in control. Now let's contrast that with a buyer's market where there's a little bit more supply. So 3 units of supply, matched up with 2 units of demand. So here, notice how these buyers have to compete with one another for the house. In a buyer's market, these sellers have to compete with one another to lure in one of these buyers. It's kind of just the opposite, which makes sense because buyer's markets and sellers markets, it turns out, are opposites. You guessed it. What we're shooting for and what seems ever elusive is this notion of a balanced market. An economist might call this market equilibrium, where the market is balanced. It's not leaning toward sellers, nor is it leaning toward buyers. It's sort of healthy, in balance, in equilibrium, well supplied, and historically, the scholarly literature, I put that in quotes. You guys can't see it. I put that in quotes. 5 to 6 months of supply is traditional. 4 to 6 or even 4 to 7 months, with some of the technological advances, I think you're doing relatively well if you have 4 to 6 or 4 to 7 months. So that's what we're shooting for. Haven't been there since 2011, so it's kind of a figment in the rearview mirror. But who knows? I think as this next cycle change could kick off, maybe we'll get back toward balance. All right, let's talk affordability and a few other trends. I think you guys will get a kick out of this. So we're going to be diving deeper, folks. God, I love those. Okay, a disappearing act. What's happening with this one? We are looking at the percentage of actives that are priced under $250,000. Using this rolling 12-month average. So under 250K, I've got our recession marked out here. I've got Twin Cities in gray, Minneapolis in blue, and our friends in St. Paul here in red. Where to begin? After the Great Recession, right? Let's just start with Twin Cities. 70% of the for sale homes were under 250K. Now that's less than 25%, right? From 70 to 23. Where should we go next? I suppose let's just look at Minneapolis. So 74 down to 30, so pretty similar decrease. St. Paul, 86% down to 54. Over half of the active listings in St. Paul are under 250,000. Now, say what you will about St. Paul. I happen to like it. I know people have strong feelings for and against. But you know what? We can't take this away from them. They have, for a variety of reasons, they have remained more affordable than Minneapolis. Again, lots of reasons, but it's even flattened out a bit. This is pretty interesting. You know what? Yeah, why not? Let's zoom in a bit. Take a look at Minneapolis here. We're seeing maybe a little bit of turnaround here. I know you got to kind of squint and turn your head to the side. Also, I think this could have been a similar head fake where we saw a little bit more, but then no, not really. And we were starting to, and then no, not really. I don't know if this time will be different. It could be. I'll promise you this. It's something that we're going to continue to monitor. I won't go through every little aspect here, but note how, in the run up to the bubble in '06, fewer properties were affordable. After the Great Recession here, obviously more properties were affordable just because of the price shifts that we saw. So yes, as we say, this is really a disappearing act. Okay, a couple of my favorites. So here we have historically low rates combined with rising incomes, and that's partly offset price gains. So we are looking at the percentage of pre-tax median income spent on the mortgage of the median priced home. Basically, how much of my pre-tax earnings do I have to spend on my all-in PITI payment, my principal, interest, taxes, and insurance payment on that median priced home? And this is going to shock some of you. This is going to shock some of you. A couple of years ago, we used to have to spend about 20% of our pre-tax income on housing. Last year, we only had to spend about 18.6% of pre-tax income on housing. What's going on? Incomes were on the rise, right, as they have been. Interest rates were on the decline, a dramatic decline. And of course, that's meant that, that's, as we say, that has offset some of these price gains. It's helped with affordability. It's helped with payments. Remember, you guys, well, maybe I'll switch to this next one now. Remember, guys, we are in a monthly payment business. People can bulk, people complain all day long about 350 grand for this, oh my God. Well, it's a monthly payment, right? So few pay cash. Some do. Some fortunate few are able to, but so few pay cash. It's a monthly payment business. So take a look at this. Here is the monthly PITI payment on that median priced home. And by the way, guys, we're not doing 20%, but we're not doing 3%. We're assuming 10% down. We're assuming 1.2% tax rate based on value and 0.5% of value spent on insurance. So we do have some assumptions. Your mileage may vary. Just know that, again, it's a broad brush. Everybody's experiences are different, but this is that sort of, this is the macro trend for the metro median sales price. So 16.25 all the way down to about 900 and now up to 1606. So sure, it's been on the rise since it kind of hit bottom, but it's actually not even back to payments during the bubble, '06 payments. I think this would be such a strong, such a compelling, convincing visual to show with some clients who are concerned about affordability. Now, look, maybe they sold a 250K home and they're moving up to 350 or 4. Well, guess what? Your payment's going to go up. You're right. But overall, people who have concerns about bubbles or other things, maybe some of those worries would be calmed by understanding this is a monthly payment business. And yes, prices continue to rise, but payments haven't. And incomes and rates play such a central role in that. All right, one more, and then I'll look at a question here. Price to income ratio, just a PTI ratio, price to income ratio. So here's the math, you guys. Incomes are about 103,000. That's a median family income. So two wage earners each making about 50, 52 a year, maybe 160 and one's 40, maybe 170 and one's 33, whatever it is. Hey, there's households with one working partner that earn $10 million a year. There's also households with 8 people that barely make $15,000 a year. So again, these are averages. Well, I guess it's a median family income. These are medians, and it's a median price. So just know, you guys, 100,000 in income on 300,000 of home price is a 3-to-1 ratio. Prices are roughly 3 times incomes, right? So if this were exactly 3 times, 103 would get us to what, 309, and we're not quite there, meaning it's a little bit less than 3. Now, we were also here at one other point in '05, right? So we went down to less than 2 times incomes, which is pretty impressive, and now we're back to 3. How do we perform in a relative sense, right? This is the theory of relativity. So affordability concerns, yeah, I think we have some, but what have I said in the past? If you're ever feeling down on yourself, just compare yourself to others that have it worse than you. No, I'm only kidding. But look at San Francisco, you guys. Median price, 1.6 million. Take a look at their incomes. So here's our income. I promise you guys, I did not make that up. Minneapolis, St. Paul, Bloomington metro area, $103,400. How about the Bay Area? $143,000. So yeah, they earn more than we do over there, obviously, but only about what, 40% more? Okay, so 40% more, that would mean, let's say 50% more house price. So 300 plus half, would that be 150? So that would be 450, right? That would mean San Francisco prices should be 450,000 based on their income if they want to maintain that 3-to-1, right? Oh, no, 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 no. It's 1.6 million. It's 11.5 to 1. San Franciscans have to spend 11 times their incomes to become homeowners, right? 11 times. San Diego, 7 times. Seattle, 6.5. Denver, Phoenix, Atlanta, Charlotte, about 4.5 to 5. Boston, 4. Here we are at 3. Pittsburgh, I found at 2.2. And I didn't get data for like Detroit, Indianapolis, I don't know, Baton Rouge. I'm sure there's some other places around the nation that are under 3, but guys, we compete with these cities for talent, for corporate relocation, for federal dollars, housing dollars, transit dollars, anything. And so, we really do compete with these cities. Oh, you know what? I should have thrown Austin on there. I think I'll add Austin. That's a good one. Maybe I should throw Portland on too. Portland's always an interesting one. So, I don't think we can compare ourselves to a Baton Rouge or to a, even to a Kansas City. I think we are in a different tier of city. So I try to kind of compare us to some of our peers, and you guys can see we are remarkably affordable relative to our peers, relative to ourselves and our own history. We're becoming a little bit less affordable. It's true. So San Francisco, just bear with me for 1 second, guys. Median house sales price per square foot, median condo sales price per square foot. You guys can see 16, 17, 18, 19 into 2020. There's our $1.65 million. I wasn't making it up. That translates into $1,000 per square foot. $1,000 per square foot means what? That means my 2,000 square foot Bloomington Rambler built in 1958 would cost $2 million, right? Well, I paid $240 for it, and now it's worth about $310 about 6 years later. So I know you guys have shown these houses. They're all built really similar, good, solid homes, steel I-beam running right down the center. And yeah, they were built well in the 1950s. But to pay $2 million for a 2,000 square foot Richfield or Bloomington Rambler is just beyond imagination. Let's do a quick time check. Oh gosh, 10 minutes. I better start booking it. So take a look at this one, guys. This is average sales price going all the way back to 1960. This is one of the reasons I love this chart, because we do look at that history. We're able to go back to 1960. Wow, is it easy to visualize our bubble here, right? Look at the run-up. This was our party. This was our hangover, right? We were so far above trend, we had to cough that up. We had to give it back, right? And then we were below trend. So we were running above our trend, and then we were running below our trend. What's so interesting, and by the way, guys, this is the channel. So overall, since 1960, prices have risen at 5.4% year over year. What I've done is I've put a 5.3 right below and a 5.5 right above, just to allow some wiggle room. So this is that channel, right? This is that channel that sort of signifies our average over the last 60 years. Well, one thing to note is that, hey, we're not even back in that channel. We're on the low side. So perhaps we're not as overvalued as some think, because we're not even back in that channel. So it's kind of an interesting thought. All right, another one of my favorites. I hope I'm not saying that about all of these slides, but I probably am. Forgive me. Housing market activity, again, long-term history, 1967. The 60s, right? What a decade. I wouldn't know, I only hear. New listings in blue, closed sales in red. So take a look at this, guys. Look at when supply got away from us, right? So demand was, sort of stable, increasing at a steady rate. Supply really had a spike here again, right? Look at this supply spike. Demand had already began to crater, right? Great Recession, 07, 09, mortgage foreclosure crisis, 07, 09. Look at this supply-driven bubble. New listings absolutely surged, even though sales were down a little bit. So these condo sellers and new construction sellers and everyone else, they're saying, well, where's all the demand? Well, it had already gone away, right? And don't forget, lenders had really closed the spigot, closed the money spigot, right? Qualified, QM rules, a lot of the qualifications, underwriting standards changed and tightened up a bit. Look at where we are now. Does this look like a bubble, right? Supply is steady, flat. Demand is, strong and growing. Let's look at the trend here. You guys can kind of see the difference over time. Here's the bubble where we really saw that run up. Look at how tight things are in this trend. Just look at how much supply and demand have tightened up. This is why prices are rising. This is why market times are plummeting. This is why sellers are getting stronger offers. This is why inventory is so low. This is why absorption rates are at 1 month of supply. All right, friends, let's talk market segmentation. Minneapolis alone, all right, 323, 67% increase, fairly noticeable. So highest level since 2011. All right, staying in Minneapolis, pending sales, 35%, also quite noticeable, quite pronounced. But that's a record going all the way back to 05. So wait a second. You want me to believe that in Minneapolis, new listings are the highest they've been since 2011, but pending sales are the highest they've been since 2005? But I thought Minneapolis was a desert. I thought everybody was fleeing the city, right? That's what so many people are writing about. If you believe everything you read, you'd best not read. What this tells us is that the records for sales are much stronger than the record for new listings. So sure, yeah, new listings have increased more than pending sales, but overall, sales reached a much longer record than new listings did. So again, just interesting ways to look at the numbers here. Staying in Minneapolis, 97.5%. If everybody were leaving and nobody wanted to move in, guess what, folks? Sellers would have to make more concessions. They'd have to drop price. They'd have to accept lower offers. And I'm not talking about seller pays. I'm just talking about straight offers. Take a look at this. Average percent of original list price. Minneapolis alone. Look at July, you guys. July. That was what, a month and a half or two after the George Floyd killing and some of the events surrounding it. About 101% of original list price, right? So in July, buyers were offering on average 101%. So pretty strong there. Closed sales above $1 million, back to metro wide, guys. December, look at this one, 54% increase, 86 in December, well above the 48 we saw. In fact, almost double the 48 we saw in 2005. How about year to date? So sorry, guys, I should have said this is all 2020. Year to date through December is obviously a whole year. 20% run up, 920 versus 480. I love the beautiful background there. So million plus has just been on a tear. And don't forget, as interest rates are favorable, so are jumbo rates. And don't forget, the stock market just kind of got back to break even. And I think it even made new highs lately, perhaps with the expectation of a more robust response to the pandemic and maybe some infrastructure planning and perhaps some COVID relief as the administration has changed. All right, guys, size matters. Pending sales broken out by square footage. What's our biggest gainer? All right, yeah, so for December, it looks to be 1,500 to 2,000 square foot homes, but look at this. For the last 12 months, it is indeed 2,500 square feet or more homes. So it's your bigger homes that saw the biggest increase in demand. Not surprising, but important to kind of break the numbers out, important to look at the facts there. All right, let's have a little bit of bedroom talk here. Pending sales by bedroom count, right? 1 or fewer, all the way up to 4 beds plus. This is December alone pendings. So we do see a pretty big gain in 4 bed plus. I guess not quite as big as 2 bed plus. Technically, our biggest was 1 bed or fewer, which is, to be honest, a little surprising. And then we look at actual closings by bedroom count, and this is for the whole year. You guys can see the numbers here. And here we do indeed confirm our suspicion that people are buying bigger homes. The biggest gainer was 4 bedroom homes or more at 12.5% versus 3 bed homes at 8%. And you guys can see down the line. All right, we are running a little shy on time. I got a little excited when I was explaining some of my charts, as I do. But guys, please do visit our website, mplsrealtor.com. You can either click on market data here or just hop down to this today in the market section. You'll be placed into this Fast Stats portal. This is what you'll see. So you'll see our locals, our weeklies, our monthlies, and then next week, early next week, we'll have our annual report. So please do check back in, take a look. These reports can really help you guys manage expectations, be more strategic about your business, so on and so forth. All right, so just a note on applications. How the heck am I supposed to use this stuff? And the WIFL, the what's in it for the, wait a minute, what's in it for the listener? What's in it for? Anyway, I thought it was a whiffle something. The what's in it for me, the WIFM, what's in it for me? So stats can answer popular questions, guys. Are we in a buyer's or a seller's market? Month supply can tell us that. Are prices rising or falling in my area for townhomes? We can get that. How long will it take to sell my home? Market times will tell you that. How much of my asking price should I expect to receive? Percentage of original will answer that. Be the expert you wish to see in the market, right? Channel your inner Gandhi, and understand that you don't have to pontificate when you're asked these questions. You can have hard and fast numbers to answer them. So just a few other notes on how this stuff can kind of benefit you. And we really encourage you guys not to discount that and to really think that through. All right, in my remaining 30 seconds, mortgage rates, you guys, 2.67%. I guess that last check it was more like 2.79. Unbelievable on the rate side of things. So you guys remember in 2018, we hit 5%. Since 2006, we've come down 60%. That's what's kept payments capped. How about unemployment rate? November last year, how are we doing? Number 2. Minneapolis, St. Paul has the second lowest unemployment rate of any major metro. Somehow we're behind the Birmingham, Hoover, Alabama metro. Not sure, I guess I don't know anyone down there. I'm sure they're good folks. I guess they got an economy that's, roaring away. Maybe some manufacturing. I know there's been some auto manufacturing relocated there, but just interesting to be behind Birmingham. But there you have it. So when we talk about the economy, 0% of economists thought we'd have a V shape, right? They all thought it would be sort of some other shape. What's so interesting, and this is fascinating, if not a bit disappointing, right? What we have is this K-shaped recovery. We came down, right? Professionals have taken the ladder up, right? They've been able to recover and get back. It's everybody else who's been struggling, and it's really a challenge. I won't go through all these guys, just know, look at what happened to gross domestic product. GDP took a hit. It's coming back, but it's not all the way back. You guys can see some of the year-over-year change there. I'm going to blow through some of these. We'll send out the slides, so don't worry if some of this is a little too fast. This one's a little bit concerning. So total non-farm jobs added. This one is a little bit concerning. And if you actually look at the change, it's even more concerning. So we lost we lost 13% of our jobs, right? We gained back, I think, 3%. And then we've really been kind of sputtering out again, as I note here, sputtering out. So here's our long-term trend going back to 1940. You guys can really see the impact of COVID on the economy. How about this one, a forced savings rate? All the way back to 1960, we've never seen a savings rate spike this high. 33%. People were able to save 33% of their earnings, right? Well, why? Well, we weren't going to bars or sporting events or really anywhere besides our living rooms, bedrooms, kitchens, and home offices. And don't forget, we had some stimulus checks coming in. So the savings rate skyrocketed. It's come down. I still think this is good news for real estate. It helps with down payments. And with that, I will stop in the name of love and open it up for Q&A. Let's see, Tim asked, are these last charts on a Fred website? Yes, if you just Google St. Louis Fed or Fred data, Fred economics, you guys will, you'll see that right there. It's really a great website. You guys can search anything, income, building permits. Oh gosh, yeah, jobs, unemployment, it's all right there. Let's see, so someone is asking how much a new listing growth is new construction? That is a good question. And for questions like that, I will hop into InfoSparks. And what I'll do is So how much a new listing? So let's look at new listings. Let me maximize here and allow me to say, let's just look at new construction. And this is over the last 12 months. And let me make this just a hair bigger. So the answer to that question is over the last year, 7%, new listings have risen 7%. So from about 10,000 to 10,700. How about just for December? Yeah, about 7.6% as well. Sometimes it's useful to actually look at the trend line and really go to the max. And this is where we can kind of see, again, a little bit of our macro trend. Because there's so much noise or volatility in the data, what I'll do is I'll switch to rolling 12 months. And here we can see new construction listings, okay, they're on the rise. I'd say a small to moderate rate of growth, nowhere near here, right? 17,000 versus about 10,000, but they have been on the rise. So that's on the supply side. What about on the demand side? Are buyers focusing on these? Maybe it's all they're able to find. Well, over the last year, I see a 14% increase in new construction sales. How about pendings? Wow, 25%, a 24.5% increase in signed contracts on new construction last year. How about just December? All right, there were 14.5. Over the last rolling 12 months, 24.5. That's significant, you guys. While we're here, and looks like I still have about 40 of you. While we're here, let's look at property type as well. So pending sales. Over the last 12 months, down slightly for condos. That's our weakest segment, right? For fairly obvious reasons. Health concerns, everything is closed downtown. Guys, so much of the downtown condo lifestyle is, dining, nightlife, restaurants, bars, theaters, plays, sporting events, and all that stuff is closed. So there's just not as much of an incentive. Also, don't forget about walkability, when we could walk to jobs. Well, many people are at home, so there's not as much demand. So townhomes up 4.5. Single family is really the winner when it comes to signed contracts, up 13%. How about just December alone? 15%. This is interesting. Maybe the losses that we saw with condos for the whole year, maybe that started to change as of December. We actually saw a 26% gain in signed contracts for condos. So that's pretty interesting. And then 17% townhomes, but only 15% for single family. How about closings? Looks like townhomes win there as well, 23% versus 22% single family and 16% for condos just for December alone. And with that, let's take a quick look. Okay, Andy is asking, yes, interest. Let's take a look. I got it all queued up right here. So someone was asking about Fred, and let's just, here, oops, Fred Econ. First thing, right, Federal Reserve, there you have it. I'll just go here, I'll just start typing 30-year. Sure enough, 30-year fixed rate mortgage average. There you go. Takes no time at all, no time. I always like to pause before I make the window a little smaller. Who out there remembers 19% interest rates on mortgages? You heard me right, folks. 19%. What's so funny is people were still buying homes back then, right? I hear people complain about, 3.25%. How will we afford that? How can we eat and pay our CenterPoint and Xcel Energy bills? Well, boy, oh boy, if people only really understood. To answer Andy's question, this is where I get our rate info, and you guys can see latest data as of 11 a.m. today was 2.77. If we actually make this, even a little smaller, there we have it, folks. We actually touched 2.675, what was about a week and a half ago. That is the lowest it's ever been in history, as far as I know, and I think this goes back to 1970. So that is at least a half a century low, right? At least since 1970. So a 50-year low. It's not every day we can say rates are at a half a century low. It's a pretty amazing thing. All right, let's get back. If there are no other questions, yes, we will email this content out to you guys for sure. I don't believe this was for CE. I hope there wasn't any miscommunication about that. So with that, guys, I want to say, I just want to thank you again for joining us. It really means a lot to us. Oops. It means a lot to us that you guys chose to join us and spend some time sort of looking at what's happening in the market. I want to thank again our sponsors, Bell Bank Mortgage, North Star, Royal Credit Union, and Supra. I want to also mention, as I mentioned, we will be emailing this out to you guys. There will also be a copy of the recording on our website, so do check for that. And we ask you to join us next month as well. These are always, it's always that third Thursday. We always have fun, as you guys see, and there's always more data, new data, different insights, different angles to kind of look at this. And we're hoping you guys will come back and join us again.
And then, David, I'll just confirm that you're correct. It is for no CE.
This is not for CE. Oh, thank God. You made me sweat a little bit there.
Sorry about that. I was trying to find my mute button.
No, that's okay. Yeah, the webinar is just sort of, a member benefit. You guys sign up, but this is not a continuing ed thing. That said, Sarah and Lacey and Janetta and Mark and I, they're in the education team. We're working to get a lot of, courses lined up. So I know we've got a couple InfoSparks classes, a couple market updates. So do watch for that. And if you're looking for something, talk to your broker and have them reach out, and we will get in touch. And with that, I will say thank you again, and we hope to see you guys next time.
All right. Thanks, David. Thanks, everybody, for coming. We'll see you next month. Have a great month, and thanks, everyone, for coming.